Having enough life insurance is one of the foundations of financial planning to protect your family against financial misfortune. But in my experience, I found that people are very uncomfortable thinking about money combined with debt, combined with all the uncomfortable, icky feelings about grief and loss. In today's video, I'm going to try and make it as simple as possible for you to make decisions about life insurance. I'll go over some of the mistakes that I've seen people make when deciding on a life insurance policy, ways in which you can make your policy more tax efficient if you already have one in place, some important principles to keep in mind when picking a life insurance policy. Hi, I'm Cleona, a chartered financial planner based in London. I don't know why I do the Zoom wave, and I love talking about life insurance, mainly because when I grew up in India, I was the eldest of 3 girls, and my mum was a single parent, and she raised us financially on her own. And every month there'd be a knock on the door from this LIC, Life Insurance Corporation of India agent, who probably got fat commission for selling her the policy, but she would tell me that he's coming to pick up some money from me. This money is going towards a life insurance policy, so if something happens to me and I die, you will be taken care of. Now, I have to say, hearing that as a child was very uncomfortable because it was quite a heavy thing to imagine my mum not being there and my mum dying. But at the same time, I really admire her practical, pragmatic approach to taking steps to ensure that nothing financially disastrous happened to me and my sisters who still needed education, clothing, and things like that. And then the burden of our care did not fall on family members who probably didn't have enough money to look after us. That's why I feel passionate about life insurance. I also feel that we shouldn't confuse life insurance with investments. So I really am a big fan of term insurance, but not so much investment-linked insurance. Luckily for us in the UK, we don't have so much of that. So when do you need life insurance? Really, when you have financial dependence, and also when you have debts and you want to make sure that your debts are paid off like a mortgage so that you don't leave things financially messy when you're gone. And the younger you are, obviously, the less medical problems you have and the cheaper your life insurance is going to be. So general principles are, if you are young, you should ideally take life insurance sooner rather than wait a few years down the line. One of the issues I see is people have maybe their mortgage covered. So if they have a decreasing mortgage, where you pay off the capital and the interest over 25 years, then they usually have a decreasing term life insurance, which is good. But then if they have kids, they don't have anything else in place to make sure that the kids are covered. And sometimes I hear people say, but I have that in service through work. Now, I've worked through the 2008-2009 financial crisis where a lot of people were walked into their office and walked out within 10 minutes with all their belongings, and they lost their death in service pretty quickly. And so unless your relationship with your employer is guaranteed and for life, which it never is, it's really best to have life insurance for the family in place separately. Death in service is like the icing on the cake. It's a bonus. It's nice to have, but for family protection, protect them separately. So when it comes to family protection, I like to talk about and compare 2 different kinds of insurance: level term and family income benefit. But with level term, suppose you go for £1 million of life insurance and you say, I want protection until I'm 65, then no matter what happens and which year you die, you will get £1 million worth of cover up until the expiry of the policy. And you might say, well, what about inflation? You can also have inflation protection with the life insurance. So that also means then that your monthly premiums go up and the life insurance policy goes up with inflation each year. And I like to compare that with family income benefit policy, where the family might say, well, we need X amount of income, let's say £60,000 of income each year until the kids turn 21 or 25 or whatever the case may be. And in that case, you can actually get more life insurance, but you're only covering the outstanding need. So I'm a big fan of family income benefit sometimes because you can actually get a lot more cover. It's slightly cheaper because the risk to the insurance company is less because you're only covering the outstanding years. What I mean is that, let's say you took £50,000 a year for 10 years, but death happened in year 9, you would only get the outstanding slice. So actually, the premiums are much lower. And you only need life insurance if you're not going to be around. So it's actually a very practical way of getting adequate insurance at reasonable premiums. But it's always good to contrast and compare the 2. Sometimes people say, I just want to know that, there will be this amount for my family, and that's it. And you can also then plug in educational fees and lump sums in the calculations financially. You can't do much about the emotional distress, but you can do something about the financial distress. And I always like to say, you're paying pennies to take care of pounds. Ideally, you don't ever want to claim on a life insurance policy, and hopefully your life will go in such a way that you don't have to claim. But as we've seen with COVID and the pandemic and wars and things that happen, and life is very, very uncertain. And the only certain thing is that we will die. We just don't know when. Take the policy, and it's important to place the policy in trust, because if it's not, then it's part of the estate for inheritance tax purposes. So the life insurance company where you apply for your life insurance policy, on their website, they'll have trust documents, they'll have guides, you can read through it. It is tiny bit boring. It's life admin to fill in forms, but it's so important to make sure that that money is protected for your family fully and not going towards inheritance tax, not part of your estate. And it's really simple to do. Don't need a lawyer, you can do it yourself. That's quite heavy. I feel like I need to lighten the mood a little bit by telling you some of the differences between working in India and working in the UK and talking about life insurance. When I was trained in India in my early 20s, we couldn't use the word death. We would say in case of an unfortunate event, or if you had to kill somebody, you'd kill yourself and say, if I were to die. And it's such a relief to be in the UK and to be able to speak about death in more straightforward language. So in summary, if you have a mortgage, you might want to pick decreasing term insurance or level term insurance depending on the type of mortgage you have, capital repayment or interest. And if you have a family, you might want to compare family income benefit and level term assurance and link it to the term that you need until the children are financially dependent or until you have financial dependent. One of the problems I see is people don't have enough life insurance. And I talked to a widow recently, and her husband was really young. He was walking in the garden and had a huge heart attack, and he'd left behind an interest-only mortgage and literally no life insurance. Now, your life has economic value. You're earning an annual salary. Your salary goes up every year, or you might be running a business. So there's something called human life value, which you can Google. But most people really underinsure themselves. Their car or other things of less material worth better insured than their lives. So my only sort of lecture point to you would be to take enough life insurance. Have a discussion with your partner. I know it's going to be awkward, but it's worth checking, is this going to be enough? And quite often, you might need to take twice that, 3 times, 4 times. People never will complain about having too much life insurance. It's usually the other way around. The other issue, of course, is you might want to take more life insurance as you get older and your earnings increase, but you might have medical health problems, and the insurance company will price that in and make it more expensive for you to get the same life insurance. So get as much as you can when you're young and healthy. So if you are a couple and you're raising a family, it's always best for both people to get life insurance. The assumption sometimes is that the breadwinner needs life insurance because their life, they're earning money and they're bringing money in, but they wouldn't be able to do that if the other person wasn't helping. And even if both are working, one person sometimes plays a bigger role in raising the kids and managing things and the emotional labor involved in looking after the children. And you have to price in the economic cost of losing that. It can be hiring babysitters, hiring cleaners, hiring support, but you have to price that in. So I would say always cover both parents. And then you can look at taking 2 single policies or a joint policy. I generally prefer the 2 single policies. So in terms of picking the life insurance company, when financial advisors do it, we have a software that allows us to compare and contrast. And we generally go with the lowest premium unless the client says they have health issues, in which case you need to ring ahead and check, that the life insurance company can cover it and, what the likely extra premium will be. In summary, I would say go with the cheapest life insurance provider. Make sure it's reputable. I can't tell you which life insurance company to pick because you can compare the prices live yourself. And I hope this video has been helpful. I wish you all the very best.